Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. The retail numbers were outstanding. They beat all the estimates, but did they really beat? We're going to show you a really interesting chart to kind of put things into perspective for you. Let's dive in.
Trade Genius.
So Bob, the market just rejoiced. We've cleared some key levels now. I think our blow-off scenario looks a whole lot better. And we've essentially erased that whole surprise rate hike from Japan, Bank of Japan. So now we're poised for higher. But is the economy really doing as good as the retail numbers suggest?
Yeah, the retail report came in, but one thing people have to bear in mind is that you could be just simply paying more than these companies selling more units. And that's important because, if I can raise my prices 10%, right, that's great, unless my costs are going up 10% too. And all we're doing is we're just playing a game of musical chairs here. And it all goes back to the government overspending. And this chart I want to throw at you here is this is mind-boggling. And I brought this chart up because I was watching on the news, they had a focus group in Philadelphia, because obviously Philadelphia is going to be a battleground city instead of a battleground state. And the people there, the folk there weren't too happy about the price of living. And they don't see, they hear these stories about, and the premise of the whole focus group was for the current administration to take credit for lowering inflation. And these people just lit that interviewer up saying, all you're doing is reducing my rate of increase. You're not reducing my cost of living. And I think this chart here just shows you what that looks like. And other people responded to this interview. It's just throwing example after example after example why this is actually bogus. There was a guy that runs 4 restaurants, and he said, you can't tell me that our price increased 2.9% year over year. He said, I'm running a 27% increase in my input costs. He said, this is just a joke. It's just not true. And I think that's what people are really feeling. So when you start seeing these retail numbers, and I was surprised, Phil, the market took off with those numbers. And I was surprised because I thought people would be saying, whoa, rate cuts are not going to happen if we're re-accelerating again. And, there's some people saying there's a re-acceleration in inflation coming. And I just think, wouldn't it be ironic if next week at Jackson Hole that the Fed doesn't talk rate cuts anymore, or we go into the September meeting and he doesn't cut rates, and he pushes it off to December because the soft landing is here and we don't need to cut rates to maintain economic progress. What do you think about that?
Yeah, here we are, this has gone up 60 some odd percent across the board. This is your consumer price index. So that's mostly everything that we have to deal with to live. And I think this is going to come down over the next few months, but I think by and large though, and this is why we keep saying you got to have hard assets, because this is just not going to go back to the way it was. And this is all, it's classic because if you look at this chart starts from 09, that's really where they started throwing money at the problem, right? Instead of, I think what should have happened is we should have had a really long sideways, boring, but healthy market that came out of the damage that was done. Learn your lesson, don't get crazy with derivatives, be responsible, but none of that really happened. And so now what we've gotten is this economy that goes from every little hiccup, it risks crashing the market, and that's just not healthy. And I think that the era of having these periods of where you have 5 to 6 year deflationary episodes or recessions, it seems like it's just going away. Now, I do think we will be taking some medicine here over the next 12 to 18 months. But I fear that what's going to happen is you're going to have another repeat of the cycle where we had in 08 and 09, and they're just going to go back to printing. They're going to say, oh, we have deflation. Oh, inflation's actually under 2% now, And they're going to go back to a very hard and fast printing that takes us out of the malaise that we're going to be in. And I think we're going to be in another situation like this round 2, except that the next time we're here, now this may be years down the road, it's going to be a far worse situation. And so that's why we pound the table about, what your investment is going to be like going into this next one. Because if you don't have something that's going to deal with this inflation that's going to end up happening later on as we head toward the end of the decade, and like Bob said, are the numbers really good? Well, if your purchasing power is getting killed, then no, they're not really good. So what's going to defend your portfolio against that? And, I would argue Bitcoin. I think metals will probably do good and things of that nature. And real estate always does good. And if you want to diversify, fine. If you want to be really aggressive, then I say mostly Bitcoin. But you have to make those choices for yourself. But if you don't do that, then even though things are going to look rosy in your 401ks and things like that, you're really not keeping up, and you really are getting your wealth is eroding against the printing that's coming.
Everybody, is Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you have not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening. Yeah, look, at a minimum, you have to beat the inflation rate by 6 basis points, right? So, and the problem is that we know 3% is really not the number. So, getting 9% on your return is really not getting you ahead. I guarantee you that.
Correct.
Our inflation rate is way over double digit. There's no question in my mind. You could just see it. And you have to just assume, Phil, that most people are in really rent mode. And if you own a house, you think you're free and clear. Au contraire. I was just joking with Phil. I turned an $80 closet installation to a $6,000 remodel. I mean, you can't get a guy to come to your house for less than $1,000 a day. Okay. And that's minimum. And I think that's what's going to happen to people is that you own a house, hey, my mortgage might be fixed, but your taxes aren't fixed. Your insurance isn't fixed. Your upkeep isn't fixed. Okay. And then if you're renting, you're just at the mercy of the rental companies. Now, some people may get deals here. Some markets will get soft. But by and large, these big, huge REITs would rather let properties sit empty than to lower their price, because lowering their price would basically cause their entire portfolio to reflect that price versus doing spot incentives or even leaving things vacant so that they can negotiate and say, hey, look, that is the rate. I don't care, if they lower the rate. And so that's what we're not going to really see it this way. And it's really scary. And what's really bothering me personally is that I don't think people really understand the retirement wave. You're losing your ability to have a job with pricing, wage increases baked in. You're going to be stuck with, Social Security and Medicare. And then the people that are under 65 or under 62, if it's worst case scenario, you got people losing their jobs in an environment where things cost a lot of money. One of my customers did a picture, popped open his back of his SUV, and he said, it just cost me $339. It was like 5 plastic bags. And it wasn't all filled with Wagyu beef, and it's just absolutely stunning how expensive it is to live. And when people have no job, I just think things are going to get really nasty here. And we see it, we didn't want to post the unemployment chart again, but this thing keeps spiking. And we know we passed that Rubicon too, Phil. So high prices, no job, or you're underemployed as a retired person, is not a recipe for, hey, we're going to V-bottom this economy. It's just going to get really nightmarish, I think, going into the next couple of years.
Yeah. And just keep in mind, too, though, the markets can juice right up into the very end of this whole thing. And Bob mentioned unemployment. The one thing that I think will really trigger the rotation in the bonds, and that's where that TLT-SPX relationship is very, very important to keep an eye on. But initial claims, now that actually came down. The number I'm looking for on that is 365,000. And I believe that when we print that, that's when you're going to see the bond trade start to happen. And that's where we're going to see a very defensive posture in the markets. And then all of a sudden, the liquidity that's available to these markets isn't going to go into stocks. It's going to go into bonds. So that's kind of what I'm looking for. We're not there yet. Hence, we can still see a squeeze in these markets. People that are hedged short or whatever can certainly unwind more positions, and things can go higher. And things like the options complex can drive things higher as well. But sooner or later, we're going to run out of steam, and the institutions are going to basically be the ones to trigger that and steer the ship. So we still got a ways to go. I still think, we have one last stop, Bob, because there is, you talk about a lower high in the market being a possibility. And we have one more number I'm looking at, and that is the 78.6 fib from the highs. The 786 fib is sitting at 55.92, so just under 5600. And so if we fail there, Bob, you still have to be open-minded to that. We could pull back there just to kind of consolidate some of this crazy squeeze back up. I mean, it's just a V reversal, classic V reversal in the market that you typically see in the bull markets. We're back over the 20-day moving average, which now is basically the line in the sand for the bulls to defend. But once we're over, like basically rounded off to 5600, hey, I think our targets towards 6,000 or 6,000 plus are valid.
Yeah, and I'd be simply amazed. I don't mind being wrong because I'm trading at long day trading every day. So, but we definitely are in the final innings here. So,
yeah.
And the funny thing about a blow off top is it'll just simply be unbelievable. We'll just be here every day saying, I can't believe this market did this today.
Right.
That's why they're called blow off tops, because they become irrational and then you become insane looking for it to turn over. But hey, look, you got to ride it and be wrong one day. That's how you have to trade it.
Right.
Unfortunately, you just can't pick it unless you're just super lucky.
Yeah. So guys, do you agree with that outlook? Let us know. Is the rising cost of living really pinching you? Let us know that as well. As always, if you need help navigating these markets, head over to tradegenius.co and check out our specials over there. I'll get you into the room with me and Bob. We'll help you navigate these markets as the volatility will increase as we get closer to the end of the year. Bob, thanks a lot for the chart, and we will see you guys on tomorrow's episode. Take care.
Trade Genius.